Welcome to the Plant Grow REIT podcast. Welcome to the Plant Grow REIT podcast. I'm James Stephen. I'm the director of the Aintree Group Wealth division. And today we're going to talk about insurance, life insurance in particular. And it's a commonly misunderstood topic. Most people kind of know they need it. They don't really know what types to get. They don't know the best way to go about getting it, and they don't know the best ways to own it. And also the other thing is, for many people who do own it, it's becoming very expensive. So we're going to look at ways to help people save some money in that space. So let's start off with probably the big overarching point is why insurance? Why would you take it out? Well, the idea with insurance is ideally you'll never use it. It's not something you want to claim on, but it's something you may need to claim on. It's like those break in the case of emergency things you see around the shopping centres. Cases of fire, that's when you get access to what you need. So in terms of a personal situation, insurance's job is to cover a gap, a shortfall in your asset base. So if you had sufficient assets, say you were very, very wealthy, you probably wouldn't need insurance, well, certainly not life insurance. However, if you're still building up your wealth and there is a potential shortfall if you weren't able to work or you passed away or suffered a serious illness, then insurance's job is to fill the gap, to make sure that there's enough assets for you and your family to continue on your lifestyle as you currently have it. So whilst we understand, why insurance, there's lots of different types of life insurance. So let's have a look at those types of insurances. So the obvious one most people understand is life insurance. So life insurance is an insurance where if someone was to pass away, they will get paid out an amount that was specified on the contract. Now, it's not necessarily on death. Life insurance, most policies have a terminal illness clause. So if they sign off to say, look, you're going to pass away, we think within the next 12 months, the insurance company will pay out early. So it's more than just the death, but it's very handy for the dependent. So the way when we're looking at calculating life insurance, we're always looking at debt and dependence. So debt, we obviously want to pay it out where possible. And dependents, we want to leave some money for them to be able to continue on the same sort of lifestyles that you'd planned before. Then you've got total and permanent disability, often called TPD, and it traditionally goes with life insurance. So total and permanent disability is where you're unable to ever work again, or that's what the specialist would assess you as. So they'll say you're totally and permanently disabled, and at that point, you'll be able to make a claim on that cover. So commonly someone who's totally and permanently disabled will never be able to work again. It could be for 20 years, and 20 years without income is a long period of time. So that's why often you'll see it paired with life insurance, because life insurance is obviously for when you pass away, but if you're totally and permanently disabled, effectively from earning money, you're not going to do that again. So hence why it's a permanent outcome. And in many cases, you actually need more total and permanent disability cover than life cover, because when someone makes a life claim, they've passed away. So it's one less person in the family for the bills and the cost of living. But if someone's totally and permanently disabled, then they're still around. So there's still costs associated with that person. So it's a greater amount in many cases. The third type covers income protection, which sometimes is called salary continuance. And that is for if you're unable to work effectively. So you go to the doctors and the doctor gives you a medical certificate to say you're unfit for work. At that point, you're eligible to claim on it. Now, there's various components to income protection, so it doesn't mean you're going to get paid day one. And I'll go through that in a little bit later on in this podcast. But it's effectively saying this cover is going to replace your income. So if you're earning a salary, you can't work, you obviously need to replace that income somehow. Income protection's job is to, now the insurer's in your employer and they start paying you on the agreed amount. So it could be the monthly amount, which is most commonly how people are paid. And as far as tax is concerned, that's your new taxable income. and they'll keep paying for as long as the contract specifies. Most people, their contracts are typically to age 65, and so it could be a significant amount of money if you're unable to work for a long period of time. But because most people don't know how long it's going to be, this is not traditionally exactly the same as total and permanent disability, because this one, people most often go back to work after a period of time. Possibly within 2 years is the most common time frame. Then the final type of cover is called critical illness. Critical illness is an insurance cover that pays out if you suffer, as it says, a critical illness. And 90% of all these claims come from cancer, heart attack, and stroke. And those are where you suffer a major event. Now, there can be different levels of severity. You can have a heart attack where you pass away, or you can have a heart attack where it just shows up in your blood that you've had a heart attack, but you don't really even feel that you've had one. So it is different levels. And that the beauty of total and permanent critical illness cover is that quite often when you get a cancer or serious ailment, you're not necessarily unfit for work. So none of the other covers will pay out at that point. But you've been diagnosed and they're prepared to pay on diagnosis. Whereas, say, with income protection, you've got to be unfit for work and the doctor has said you're not going back to work. Now, if you think about that with cancer, quite often in the early stages, you generally are relatively fit for work. But for most people, what they don't want to be doing is going back to work, when really they want to be just focusing on getting better. So the idea with critical illness is that you get the lump sum, means you don't need to worry about working, and you can just focus on your health and getting better. Because particularly with cancer, early diagnosis and early treatment, for most cancers, is a very high chance of survival. So the earlier you get to it, the better. So if you've got some funds, you don't have to worry about working, you can get on with it. So that's the four main types of covers. They all play a role, and quite commonly people will want to get all four. Most people don't have all four, because most people have most of their cover inside of superannuation, which is the life insurance is commonly housed in there, total and permanent disability and income protection. Critical illness can't be owned under super, so most people typically don't have it under super, and they don't know about it. A statistic I saw a little while back was about 3% of people have critical illness cover, even though it's one of the most claimed. Since I've been doing it in the industry, critical illness and income protection are the two most common claims that I help people with, not life insurance or total and permanent disability. And the reason is life insurance, the average age of death in Australia is 84, 87, depending on whether you're male or female. And almost nobody has life insurance at that age. The vast majority of people get rid of it when they retire, if not earlier. So when it comes to getting insurance, there's different ways to own it. As I mentioned before, most people own it under super, and that's largely because for cash flow purposes, and also because when you get a superannuation plan, most of them will have an automatic level of cover. So they put it in there automatically without you doing anything. So that's why they'll have it under super. The other option, which is where we will come in, is the personally underwritten insurance. So that's where you go and get a policy specifically for yourself for these type of covers. And in that case, what that means is you've got to go and get underwritten by the insurer. So they will assess your health, and they'll assess the activities you do in your life, and they'll put together a picture of you, and they'll go, okay, we're happy to insure this person. And they will give you a contract, a life insurance contract, to say if you meet these definitions and you keep paying, if you keep paying your premiums and you suffer an event where you meet a definition on the policy, at that point they'll pay out. And from my experience, I've never had a claim knocked back that's legitimate. So if there's been a legitimate claim, they've paid. And that's been in the last 20 years. So I'm very confident when people do claim, they will get paid out. And for life insurance companies, particularly the type we deal with and the type of personally underwritten insurance I've spoken about, they have an interest in paying out, because if they've priced their insurance properly, they're profitable anyway. And when they pay out, that's good for their marketing, because they can say, well, we've made X amount of payouts this year. Now, billions of dollars is typically what they pay out across the industry each year. So it's great for them, because, if people see that insurance companies are paying out and it's valuable to get this cover, well, they're gonna get more customers. So the onus is on them to make sure their insurance cover is profitable. And then we'll get back to the super side of things. So with superannuation, it is, as I said, it's the most commonly way, and it's most done. The reason why most people do it, other than automatic, is for cash flow, because they don't have to fund it out of their own funds. But just bear in mind, when you're considering having all your money or your insurance under superannuation, is that it might be reducing your current cash flow or demands on your current cash flow, but it's effectively it's going to now impact your future cash flow when you retire, because it's going to come out of the value of your superannuation. So there's no free lunch here. You're either saving it today or you're saving it later. So you just got to bear that in mind. If you're loading up all that cover, whilst you might feel like, yep, I'm miles away from retirement now, at some point you're going to get closer to it, and you're going to, at that point, you're going to want as much superannuation as you can get. So that is the balancing act. And we have to always, when we give advice to people, just make sure that we've looked at both sides of that equation. Certainly bringing awareness to people about those impacts, and to mitigate that, people will often make extra contributions into superannuation, pre-tax contributions, where they get a tax deduction. So you can kind of have your cake and eat it. And then in terms of just reducing costs, I think I mentioned that before. People at the moment, the cost of living is very high, and it's gone up dramatically, whether it be people's mortgages or their shopping bills or transportation. Insurance is the same. The costs have gone up dramatically. And I regularly get people say to me, well, how do we save money on insurance? We know we need it. We can't not have it. We got a young family, or we got high debts, or they've got a particular reason for it. But how do we save money? Well, there are different ways to do it. I've mentioned through superannuation is one option. Other options people can utilise, particularly with income protection, which is a commonly sort of questioned one, because it can get expensive, is that they have a waiting period and a benefit period. So the waiting period is how long you are prepared to wait before they start paying. So I mentioned you need a medical certificate. The doctor will sign off to say unfit for work. At that point, the waiting period starts. So the question is, how long are you prepared to wait? Now, you can get a waiting period as little as 2 weeks and as long as 2 years. So the premium itself, the cost of that insurance, is going to depend on the waiting period. The longer the waiting period, the cheaper it is. So for most people, 2 years is completely not viable for them. So they don't go down that path. But the other problem is the 2 week waiting period is very expensive. So we have to juggle the waiting period there and find the sweet spot. And for most people, it's probably around 90 days, because you can save about, the difference between 30 days and 90 days is about 40% cheaper on premium, which is a big saving. And the way I explain to clients as well, if you just save some money and have some money in a offset account or in a bank account where you can access it, you're going to then, that'll tide you over until the waiting period's finished, and then you start getting paid. So that's one, extending the waiting period. Two, the benefit period. So benefit periods, most people will get income protection to age 65 if they get it personally underwritten. Now, the problem with that is it's obviously going to be more expensive to age 65 than a shorter benefit period. So I've been to some presentations with a few insurers about where the sweet spot is, where you can sort of reduce it dramatically, but also not risk needing it for longer and not having it anymore. And it's 5 years is a good number, 2 to 5 years, because they say that about 93% of all people are off claim within 2 years. So within 5 years, it's closer to 100%. It's not 100%, but 5 years is a nice spot. So a 90-day waiting period and a 5-year benefit can be that sweet spot where you can have your cake and eat it, so to speak, in that you've got good cover, but it's much cheaper than otherwise would be. Now, of course, there's going to be those people where they slip between the cracks and they don't fit that statistical model, and they are the 1 or 2% that are on long-term claims. That's where the total and permanent disability comes in. So that's a lump sum that's going to pay out on a permanent disability. And if you think about it, if it's gone past 5 years and you're not able to work, it's probably going to be the case that you would be eligible for total and permanent disability anyway. So that's why you want all the different covers, because they all sort of fill gaps and they all put together a nice sort of plan B, if you will. Because we're all planning for plan A, which is I'm going to retire comfortably, I'm going to retire early, I'm going to do all this and this. Well, this is your plan B. It's just in case something goes wrong. Well, you can call the insurer, or actually, when we do insurance, they can call us because we help them with the claim. So every claim that any of our clients are involved in, I will physically help them get paid. I'm not guaranteeing that because I'm not the one paying it. But if the claim is legitimate, almost every claim, well, everyone I've been involved has paid out. So we help people get their payment. And then if there's any particular planning around that, we can help them as well. But not always, they don't always need specific planning like, oh, we're going to invest this money or do that. It's quite often the insurance is needed to pay the bills. So it's not like they're going off and, setting up an investment plan. It may well be that they're just paying down the home loan. And then putting some money into an account for the kids' education, and then maybe after that they'll invest a bit to make sure that the family can keep earning or living off this income for as long as possible. So that would be the way you can save money on that one. Other ways would be obviously less cover. I still argue that whilst you want to get the ideal amount of cover, less cover is better than no cover. So you'd rather say, well, if I've got half the cover I need, I've solved half the problem. Then I only have to find the other half. So you can reduce it. That's definitely a way to do it. There's normally indexation on the policies, like where it goes up every year for CPI. So that's another way you can drop that off. That means the premiums aren't going up as much. Or another cover, if you start younger, you can set up all your insurance policies on what's called a level premium. So there's two types of premiums, there's stepped and level. If you think about it, the step goes up each year that you on your birthday. So it's like climbing a set of stairs. It just gets more and more expensive as you get older. Not a big deal when you're 40 and under, but once you get really sort of mid-50s onwards, it's really expensive. So what we try to do with clients is work out, is it a long-term cover or is it for short to medium? If it's short to medium, we'll go with step because it's cheaper. If it's a long-term cover, I need this cover for 25 years, then we'll make sure it's level premium. And level premium, whilst it's more expensive day one, there's a point in time around about 8 to 10 years where it gets cheaper than the stepped. And from then on in, you're saving every single year. And it'll be affordable when you get older. So that's a juggling act with the costs that we want to do. So we'll always look at ways to make it affordable and also to be owned in the best possible way for you. Just a few dangers to be aware of with insurance is a lot of people will get encouraged by their super funds to consolidate their super. This is it's seen as, well, you reduce your fees. Why are you paying multiple sets of fees? Why don't you just fill in this form and all your cover can be consolidated? Also, people will do that when they go onto the MyGov website. They can consolidate all their super in one go very easily. However, if you consolidate your super, you have to be aware of what benefits you're losing, because there's a lot of insurance cover inside superannuation plans. And if you've got like 3 insurance super plans, you may have 3 insurance policies, which are covering what you need. So the last thing you want to do is consolidate all your super into one fund. Now you've got no insurance and you didn't even think about that. So it's very important to at least assess your insurance needs first before you roll over. to make sure that if you are going to do that, you set your cover up in the new fund. So it's ready, it's waiting for you, and then you can consolidate and not worry about losing the insurance. That's a big one. And also the government legislation around this area is a bit tricky, because what they've done is they've created a scenario where if people aren't doing anything with their super, like not making any contributions for for more than 18 months or 16 months it is, the insurance, the super fund has to write to you and say, do you want to keep this insurance? So they'll cancel it. So if you, for some reason, like someone's off with maternity leave, or they've gone overseas for a period of time, that cover will potentially be stripped out of the policy, because if they haven't heard back from you after they write that letter, they can cancel it. The other one is if you have an insurance a policy with less 6,000 or less in your super fund, they will cancel that insurance policy as well if you don't ask to keep it. So that's a little bit of a danger which comes up, and the problem is it's all fine if nothing goes wrong. It means you've saved money along the way. But if something goes wrong and you need to claim and you thought you had cover, well, you don't have it. That's a big problem. And I've seen that firsthand, where people think they got cover, but they don't. So before you consolidate super or try to save fees in that area, it's really, really important to make sure that your right amount of cover's definitely guaranteed in the right spot. And probably the last danger really is around cancelling cover before you get new cover. So people will go, oh, this policy is too expensive, I'm going to change insurers. And then they go through underwriting, which is where you put all your health details on the table for the insurer to assess. And then they cancel the old policy, assuming they're just going to get the cover. There's no such thing as that. Quite often insurers will come up and they'll say, oh, we found this and we're not going to cover you, or we're going to charge you more. So all of a sudden you got a more expensive policy, or you got no cover. So never cancel the policy before the other cover's in place at good terms that you're happy with. Because it might start off being cheaper on the quote, but by the time they've gone through your health, they go, no, you're paying an extra 100%. So that's a big sort of danger to be wary of. And I just thought I'd just maybe take you through a couple of case studies, just some areas where it can come in pretty handy. I had a older couple, and one of them, well, he's the primary breadwinner. So he was a good income earner, but they had a reasonably expensive lifestyle, and they had no super. In fact, all the money in super was going to pay for the premiums, which was bit unusual, but he was determined to make sure that his wife would be okay if something happened to him. And something did happen to him, and he did pass away. And the fact that he had kept paying those premiums, even though it was eating away all of his super, meant that she's comfortably retired, like literally provided all the super she needed. And, I still look after her, and she's 100% fine, but if there was no insurance, she would not have any money. So it's a massive outcome for her, and good on him for persevering, even though like a lot of people would have cancelled at that point. And another one I can think of, this husband he had 3 kids with his wife, and he died at 40. It was quite sad. Wasn't sure whether it was suicide or alcohol poisoning, but he had an issue with alcohol, and it was hard to get him insurance. So actually what we did was we cobbled together a number of policies through different super funds where they had that automatic cover. So we had 2 or 3 of those, and we'd managed to get some cover in place with another super fund before he had run into trouble with the alcohol. And so he had a pretty good mix. He had a pretty good mix of cover. And then when he did pass away, fortunately, between all the super funds and all the life insurances, they were kept going, even though everyone says consolidate them. He and his wife ended up with a significant amount of funds to be able to look after herself and those 3 young kids. So that's another example of if you were just worried about cost and just consolidating, that would not have been there. It wouldn't have been in place. So And to this day, it's made all the difference, massive difference to their lifestyle. So that's another benefit. I'm not saying it's always going to be a benefit, because there's plenty of people who never claim. It's just a statistical thing, but that's why we got to juggle, your plan A with your plan B, and just making sure there's enough there so that there are gaps filled. And the third one was certainly the least tragic out of the three. This lady with a young child, husband, large mortgage, had breast cancer. She had a critical illness policy, and it was, a good outcome. She's 100% okay. They were able to get it early, and then just went through radiation therapy and a bit of chemo, got it, and it's never been a problem since. But she was able to take off a year because of the insurance policy. So it allowed her just to not worry about financial matters, just get better, and she was able to stop working and just focus on getting better. And that is really the purpose of the critical illness cover, is to get better so you don't pass away or don't go too far. So that's really a little bit of a snapshot of insurance. There's a lot to talk about, and we could talk about all of these areas that I mentioned in much greater detail. But unfortunately, we don't have the time. But we may unpack each little component in more detail at a later date. Now, obviously, if anyone's interested in talking about it or looking at what the cover they got, do they want to compare that to what's out there, or what do we think? We're happy to do that. Just give them an assessment. And if they got cover and they're not happy with who's looking after their policies, they can bring it to us. And like I said, if there's any claims when we're looking after it, well, we'll help that policy get paid out. That's our claims guarantee that we help all our clients with. Anyway, I hope you got some value out of this. Hope you learned something. And I hope you have a fantastic day. So thanks for listening to the Plant, Grow, Reap podcast.